All right, let's talk about last week. The market, honestly, it felt less like a financial system and more like one of those frantic arcade games. You know, the one where every time you think you've got it figured out, another problem just pops right up out of nowhere.
And this quote from Art Hogan at B. Riley Wealth, man, it just nails it. Investors were basically playing this high-stakes game of whack-a-mole, just reacting to one AI-driven fear after another, each one popping up and demanding an immediate smackdown.
So to get you geared up for the week ahead, we're going to lean on some amazing insights from the AGI Roundtable. We're going to break down the three biggest moles that popped up on the game board: the scare trade, the capital wall, and the Fed pivot. Trust me, understanding these is absolutely key to figuring out what's coming next.
Okay, so the first mole to pop its head up was just pure raw fear. The AGI Roundtable has a great name for this: the scare trade. This is where the market wasn't really reacting to hard data or earnings reports, but to these terrifying stories about what AI might do down the road. In fact, Wall Street even came up with a name for it: SaaSpocalypse. And look, this wasn't just some minor dip. This was a wave of actual panic, all built on the idea that AI wouldn't just be a helpful tool, but a force that could completely wipe out entire industries.
So the crucial point here, as the Roundtable's Zephyr pointed out, was how the whole story just flipped on its head. We went from this optimistic narrative of AI efficiency, AI helps us do our jobs better, to a much darker story of AI displacement, where AI just straight up takes our jobs, makes our software subscriptions useless, and leaves our office buildings completely empty.
And this fear, it just took off like wildfire. I mean, it hit the obvious targets in software, sure, but then it jumped over to logistics and even slammed commercial real estate stocks. And you gotta ask, why? Well, the theory was pretty simple. If AI deletes millions of white-collar jobs, who on earth is going to need an office?
And this is where it gets kinda crazy and really shows you the superstition that was driving all this. The whole logistics sector crash, it wasn't triggered by a bad earnings report or some new tech being rolled out. Nope. It was triggered by a single company's press release that just claimed it had a new AI. Billions in value, just gone, based on what was basically a ghost story.
All right. Let's shift gears to the second mole, because this one wasn't a ghost. It was a very, very real, massive wall of money that completely changed the rules of the game.
So first up, Google just dropped a bombshell on Wall Street. They announced their projected spending plan for AI infrastructure in 2026, and the number was just eye-watering, up to $185 billion.
But wait, the shock wasn't over. Amazon looked at Google's number and pretty much said, "Hold my beer." They announced their own plan for 2026, a staggering $200 billion.
And then, when you throw Meta and Microsoft into the mix, the total projected AI spending from just these four hyperscalers climbs to an almost unbelievable $650 billion. I mean, to put that into perspective, that single year of spending is bigger than the entire economy of most countries on the planet.
Now, what's so wild about this is you're looking at the org chart for a new AI arms race. This isn't just friendly competition anymore. This is a war of attrition where the only companies that can even afford a seat at the table are the ones with budgets the size of a small nation.
The AGI Roundtable calls this the matrix economy, and it's like a two-sided coin. On one side, this wall of spending just completely crushes smaller software companies and startups that have no chance of keeping up. But on the other side, it's a massive economic stimulus. They call it a CapEx cushion for all the companies actually building the physical reality of AI. We're talking hardware, energy, and semiconductors.
And just when you thought it was all about AI, bam, the third mole pops up. And this one had nothing to do with technology, but everything to do with a huge shift in policy. A new nominee to lead the Federal Reserve. So, meet Kevin Warsh. This guy is a Fed veteran. He was right there in the thick of it during the 2008 financial crisis, and he has a very clear record as an inflation hawk. This is someone who has publicly pushed back against easy money policies for years.
As Hunter from the Roundtable pointed out, the market read this instantly as the end of an era. Specifically, the end of the Fed putt. You know, that old belief that the central bank would always jump in with a fire hose of cash to save the markets? Well, it looks like those days might be over.
But here's the crazy part. Despite this pretty hawkish pick, the markets were surprisingly calm. So why? Well, it turns out a lower than expected inflation number, the January CPI print was just 0.2%, kept the dream alive. It hinted that inflation was cooling, which kept hopes for future rate cuts on the table, balancing out the Warsh news.
So you've got all these moles popping up all over the place. Fear, money, policy. What's the actual game plan? Well, the AGI Roundtable says it's not about frantically trying to whack every single mole. It's about knowing which ones are real and which ones are just illusions.
And this brings us to the most important point of all. The real key here is learning how to separate the superstition, all those ghost stories driving the scare trade, from the undeniable gravity of the market's real valuation. One is a phantom, the other is like a law of physics you just can't ignore.
So their strategy really boils down to 3 pretty simple steps. Step 1, respect valuation gravity. The market is expensive, so don't get reckless. Step 2, buy the physical reality. Follow that $650 billion wall of money into the companies that are actually building this stuff. And step 3, which might be the most important, ignore the ghost stories. Don't let a scary press release make you panic sell your portfolio.
As Phil from PSW summed it up perfectly, the robot takeover isn't scheduled for this Monday. The smart move is to focus on the real, tangible value being created right now, while always remembering that we are playing at a very, very high altitude in terms of market valuation.
And that leaves you all set for the week ahead, with the game board reset, and really, there's only one question left to ask. Which mole is the market going to throw at us next?